How you doing? Thank you for taking a few minutes to join me today. I'm really excited about my new business partner, Anna Mancuso. She has we've been in contact with each other for a while. Anna is a very impressive investor. She is from Canada, and just a couple of weeks ago, she spent several days here in Indianapolis with me and with my team, vetting out our operation. Anna is a successful entrepreneur. She began in custom furniture manufacturing. She's been very successful in obtaining financing for business with little to no capital to start out. She does business coaching. She's been a real estate investor since 2006, and she's consistently concluding transactions that have garnered immediate equity. So needless to say, when Anna heard of the returns, 15, 20, 25% returns that investors from Canada, from the UK, from Singapore, from all over the world are generating with our team and with our system, she was very interested to come down and see how we were put together to vet our operation out and to spend some time basically understanding what we were doing. Anna has been carefully analyzing the U.S. market for Canadian real estate investors, and because of the affordable housing and because of the capital appreciation and because of the opportunities with the Canadian dollar and the U.S. dollar, Anna made the decision that her clients and the people that she networks with and works with need to be invested in U.S. real estate. Now, Anna is going to give you information about our operation, and currently we have property management, construction, leasing, acquisitions, all under one roof in Indianapolis, where we're managing 1,500 properties, in Dallas, Texas, and Fort Worth, Texas, where we're managing several hundred properties, Kansas City, Missouri, where we've acquired over 150 houses just in the last year alone, and then our newest markets of Charlotte, North Carolina, as well as we're doing homework on entering into the Houston market. So in a nutshell, Anna and her investors are looking to buy these homes from us, and then we do all the management for them on the back end. Now, one of the most common questions that we hear from Canadian investors is, do I need to set up a U.S. entity? Do I need to set up a corporation in the U.S.? How does it work with my taxes? Now, I am not an attorney. I am not a CPA. I have studied U.S. and Canadian tax laws. I've met with U.S. accountants about it. I've met with Canadian accountants. I have spent many hours studying the legal implications for Canadian investors, how to structure the acquisition of the properties. One of the things that Canadian investors should remember is that the U.S. and Canada obviously have excellent relationship. So, for example, from a tax standpoint, it's very favorable for a Canadian investor because if you buy U.S. rental properties, you will have to file a state tax return here in the U.S. in the state that you buy the properties. So if you buy a property from me here in Indianapolis, you'll need to file an Indiana state tax return. We have accountants here in the U.S. that are happy to do that for you, that know how to do that for our international clients. And then you'll have to file a federal tax return. You should expect to pay here in the U.S., if you have less than 5 properties, about 15%, 15 to 20% on taxes, state and federal, that's combined. If you have more than 5 properties, you'll be paying up to about 15 properties. You'll be paying high teens up to 25% combined federal and state. So keep that in the back of your mind. Now, the great thing that the U.S. and Canada have had for a long time is you don't get double taxed. So if you pay 20% off your rental income for the state and the federal taxes here in the U.S., and then you go back home and you don't owe more than 20% off of the income that you've earned, then you don't pay any taxes in Canada on that U.S. rental income. It's a double taxation treaty, what they call it, and it's you only have to pay the difference. So you would only pay taxes on your U.S. rental income in Canada if your tax rate was higher than what you had paid in the U.S. So think about what you pay for your income tax every year. If it's higher than 20%, then you will pay the difference. If you paid 25% on your money last year, your U.S. taxes come in at 20%, then all you pay is the additional 5% to the Canadian government. And we have the knowledge with Anna to put you in touch with the right accountants who can handle that for you. Now, if you have a Canadian corp, it's incredibly favorable from a tax standpoint for you to buy U.S. properties, because for the most part with a Canadian corp, you're only looking at 15% annual tax. And so if your U.S. taxes are 15 to 20%, again, there's a very low likelihood that you're going to owe anything to the Canadian government on that rental income. Again, I'm not a CPA, I'm not an accountant, but I am a businessman who's bought over 4,000 properties, and I do have hundreds of clients all over the world. So we see how they're structuring after meeting with their accountants. And what I wanted today was just give you kind of a condensed version, a nutshell, a non-professional summary to use as a starting point as you go out and study this in detail for yourself. Okay, I've seen investors who use U.S. LLCs. I've seen LLPs. I've seen investors take their Canadian corp and make it the member in a U.S. entity. My personal opinion is that, again, if you own less than 5 properties, you don't need to go to those lengths, because what will happen is the setup costs for all of those U.S. and Canadian entities and the annual filing fees for your taxes, if you own less than 5 properties, just doesn't make it worth it. It doesn't make it worth the fact that you're only going to make a few $1,000s in net rental income. And if you spend a few $1,000s setting up all these Canadian corps and all of these U.S. corporations, it ends up being a wash. So it's not, in my personal opinion, if you have less than 5 properties, it's not worth it. Now, if you don't already have a Canadian corporation, I still think that you should consider using a sole proprietorship for less than 5 properties. Again, it's expensive. It's much more expensive in Canada to file a tax return for each corporation. It's expensive to set those entities up. It's expensive in the U.S., and I just don't feel that it's worth it. Now, some people will talk about liability, but we've found that liability in managing thousands of properties is more related to the kind of landlord insurance that you have. And the policy that we put you in touch with will have $1 million of liability coverage. And you know, last year, managing over 2,000 properties, we didn't have one liability claim. As we've looked at insurance industry statistics, I see a lot of lawyers who scream about this is a litigious society, everybody wants to sue you, but the actual number of landlord liability policy claims that get filed every year is not 10% of all policies, is not 1%. We're talking less than 0.1% of all landlord policies see claims coming in against their liability policy. So you have a much greater likelihood of an earthquake on your property, or a tornado, or hail damage, or theft, or fire, act of God type damages to your property. Again, those are covered by your insurance as well, and we put you in touch with that. But my 2 cents as a non-attorney, a non-accountant, is don't spend a lot of money setting those things up unless you get to 5 properties and more, because then it does start to make sense, and there are some real reasons for you to do that, and that's something that we can put you in touch with the right people. But what we also find is when people do have the money to buy more than 5 properties, usually they already have their own tax and legal in place. So more than anything, this video is for those of you who are just getting in the game, have no idea what you should do. So my 2 cents is, if you have a Canadian corp, you want to go ahead and buy the U.S. property with that. We can, you don't need a U.S. bank account. We can ACH or direct deposit your money into your Canadian bank account without any problem every month. And then from a tax standpoint, we'll walk you through filing your state taxes and your federal taxes here in the U.S. And then if you owe any more, because you pay a higher tax rate in Canada, then we can walk you through that as well. So that's my brief synopsis of what I think you should be doing in terms of buying properties. First thing you want to think of, am I going to be buying more than 5 or less? If I'm buying less, do I already have a Canadian corp? if I already have a Canadian corp, I think you should buy your U.S. property with a Canadian corp. If you don't already have the Canadian corp, then you want to really maybe think twice about spending the money to set that up, because it may not be worth it. From a tax standpoint, the big benefit of the Canadian corp is 15%, but the likelihood that you will go over that after filing your U.S. returns is fairly low. So these are the kinds of things that Anna is well versed in. She's very impressive. We're very excited to be working with her. Every month we do a field training in Indianapolis. For most of you, that's just a couple-hour flight away. We'd love to have you come spend 2 days with us on a weekend. Anna can give you those dates, and really see our operation, see the 1,500 property operation that we have, and see how our team is specifically set up to find the properties for you, sell them to you, and then do all of the management, all of the rental collections, all of the construction going forward, all under one roof. We don't outsource any of our operation. So thank you for taking a few minutes to check this video out with us today, and we look forward from hearing from you soon and doing business with you as well.